Hello everyone, this is Sebastian McMahon from IA Financial Group. I'm back with the weekly economic review for the week ending January 20th, 2023. So a look at the markets at the close on Thursday to start us off. Positive returns again for bonds and year to date, 4% on the Universe Index, 7% for the long index, so very good news. Only 3 weeks in the books. We do have expectations that we should have positive returns for bonds in 2023. At least this is how we're positioned. This is what we anticipate. The year is pretty young, but at least we should expect to have better year than the previous two, which were negative, of course, for the asset class. So interest rates higher, so that's a tailwind for the asset class. And if we do have a slowdown, we have a volatility, we have a recession, anything can happen in 2023. That could mean that market rates fall, so capital gains for fixed income. So we like fixed income in 2023 as we're standing here on January 20th. Equities negative on the week, a bit of a pullback. Remember last week in the review, if you haven't watched, I encourage that you go take a look. We looked at how the S&P 500 kept hitting the resistance level through 2022, and we were at resistance last week, and the market hit its head against it and pulled back this week. So let's see if it continues to hold, but so far so good, meaning that we are still in a bear market, we're still in a downtrend. And the picture that we see here, lots of optimism in the first 2 weeks of the year, turn around this week. So let's see how we end up, but we do continue to expect that we will be retesting the market lows, the October lows in 2023 on Wall Street, on the S&P 500, but we have warmed up to the Canadian stock market, the European stock market, emerging markets through China. So we raised our positions over there. And on the flip side, we went even more underweight in the US. So we think that these markets will outperform the US, as the US stock market is one of the most expensive in the world right now still. So these are the changes that we made. We also bought some gold last week. So far so good. A small positive return this week, but oil higher, Canadian dollar a bit lower, and gold, as I said, 0.6%. So this week I'll talk about inflation again. We'll talk about it more shortly because it is coming down. That's a good thing. The slowdown in inflation continues. We did hit what seems to be the peak last summer, and since then we've been sliding lower. The base effects, meaning that when we compare here the month of December 2022 with December 2021, the base effects are becoming less and less kind to the inflation figures. So we're comparing two levels that are maybe getting closer and closer one to the other. So that's a headwind for inflation here. This base effect should continue through the year. But when we look at the components here, well, as you can see in the chart here, it's mostly the yellow or orange part that is contracting. So that's transportation, that's mostly gasoline prices, new and used cars. And when you look at the bottom at food in dark blue and shelter, let's say green, blue-green part, you're seeing that it's still going sideways. So inflation in food and inflation is still there. The story for the Bank of Canada to continue to hike or to keep rates high remains in play. We do expect a rate hike of 25 basis points next week, January 25th at 10 a.m. Eastern time. I surveyed the big Canadian banks this morning. The forecast is majoritarily pointing that way too from these banks. So it's in the consensus, so it wouldn't be necessarily a surprise if we have a hike next week. We do expect a hike, but with a tone that would say that, all right, maybe starting from now, a pause is warranted, or maybe hinting that they will be truly data dependent and maybe wait it out. So this is what we're expecting, but important report coming out next week. Housing now, we had the Terranet National Bank indices on the week. That was for December, and month over month on the left you see it's the 7th consecutive month of drawdown in housing prices. So the impact of the rise in interest rates is working its way into the market. And on the right, year over year, now it's 0%. So when you compare December 2022 to December 2021, flat on the price. So if someone bought in late 2021, well, no change in price yet. But if someone bought during 2022, then it's a different story. Maybe the next chart here, we now have a drawdown of 10% from the recent high. So the high was in early 2022, and now we're seeing a drawdown of 10%. But seeing the big picture is key here. The Canadian housing market is not crumbling, it's not falling down. That's not what's happening. You need to look at the chart on the right. So this is the evolution of housing prices in the main cities in Canada. So every city there was standardized at 100, the price level at 100 in January 2020. And as you can see, over 2020, 2021, prices rose by 30, 40, 50, 60%, which is not normal. And this is fraught caused by interest rates that went to almost zero, and a change in habits. Of course, people left downtowns, went into the suburbs, all of that with a telework story, but this seems to be now behind us. So now, if lower rates cause this, well, if you take rates and you take them from the floor, you raise them to 425, maybe 450 next week, of course it's normal that you give back some of these gains. So just to put some perspective on that, and even if we lose 20, 30% from the most recent highs, we would still see majoritarily positive gains here in housing prices since early 2020. So that's exactly the point. If an asset class like housing, you see prices start to rise and you fear a drawdown in these prices, well, that means that the bubble is getting bigger and bigger. And when a bubble bursts, that's when you have big problems. That's when you have human impacts. And just look at what happened in the US in the 2000s. You don't want to let the bubble just get bigger and bigger and just pop. So this is actually something that's a necessary, a good process for Canadian housing prices, in our opinion. Just wanted to give some perspective that yes, if you bought at the peak, well, it's not a pleasant market development, but you need to look at the big picture here. So next week we'll see the Bank of Canada's rate decision. We'll also have a new forecast from them, so it's going to be an interesting meeting. In the US, we'll have the global PMIs from S&P. The US PMIs from S&P Global, rather, very important market indicators because they come before the ISMs, so we always follow them. 2022 Q4 GDP growth, 3% or about 3% is expected. Remember that we had negative growth in Q1, Q2, then positive Q3, positive Q4 likely. Now 2023 looks softer in the forecasts, so that's going to be an interesting analysis there. And the PCE deflator was that? Well, that's another measure of inflation in the US. So they have the CPI like us, and the PCE is just that it reacts more quickly to the changes in the habits of consumption of households, and the Fed favors this one, so we follow it. Should be a bit lower to 4.4% year over year, so we'll be following that. So ia.ca, your go-to webpage. You can subscribe to the newsletter if it's not done already. In Your Interest podcast, we tackled cryptocurrencies, the FTX story, and the basic principles of investment this week. So strongly encourage that you give it a listen. Economy and Finance 101, some material is coming, and social media, Twitter, LinkedIn. As always, you can follow us there. So that wraps it up. Thanks everyone, and I'll see you again next week.